My name's Nick Sinclair from Wealth Farm. Today we're here to talk about how can I afford to invest. My question to you is, how can you afford not to invest? Now, most people don't actually understand the difference between an asset and a liability. What most people think an asset is their home, their boats, their cars. But what we're here to tell you about today is that they're actually liabilities. An asset is something that pays you an income. A liability is something that costs you money. Now, if you look at all the things that you own, how many of them actually pay you an income? I would guarantee that the majority of them don't. So what are you going to live on when you want to stop working? When you've had enough of your boss, you've had enough of turning up to work, what are the assets that you're going to live off? For me, I know that I enjoy my work, but I have the choice of whether or not I go there. Now for you, you need to create the assets to be able to do that. So you need to understand the difference between good debt and bad debt. Like we've just discussed with the assets and liabilities, anything that costs you money is a bad debt. The acceptance of that is where you earn an income. So an investment property or borrowing money to invest in shares, that is a good debt. One, because you'll get a tax deduction, but two, because you bought an asset that's going to grow in value. A bad debt, unfortunately, are all the things we enjoy. Our boats, our cars, our jet skis, our houses. These are things that we need to really focus on paying off. So how do we leverage, or how do we maximise the amount of investments that we can have? There's a few simple ways. The first one is to go and work 40 to 60 hour weeks, work your butt off, get paid, pay your tax, and hopefully you have enough left over at the end of the week to be able to put towards investments. The second way, or the easy way, is to marry it. Find a sugar mama, find a sugar daddy. Marry someone that has money so you don't have to worry about working. There's another way, win it. Go to the pokies, put your money on the lotto. Hopefully it's enough for you to be able to win it, and then you won't have to worry about working. The easiest way though is renting it, borrowing money from a bank, an institution or a friend, and using that money to invest. Now the key thing is when you're investing is to make sure that the asset grows in value and that the debt level either stays the same or reduces. Now the key thing is, it's not how much you own or how much you owe, it's the difference between the value of the asset and the debt that you have on it. And that will only increase over time. So can I afford a loan? Now most of our clients when they initially come and see us are paying their loans on principal and interest. But most people don't actually understand the difference between principal and interest only. Interest only means that you're only paying the interest of the loan. You're not actually reducing the capital amount. But what that may mean is that you can actually use some of that surplus money that you're not paying off the principal to actually put it towards investing. So in some cases, it may be better to actually put your home loan on interest only and utilise the surplus funds that you've now created to put towards an investment that will grow over time and pay off your home loan quicker. But what about if interest rates rise? And this is the thing that we're really concerned about and really worries us when people go and borrow money from banks. They don't actually consider what is the true cost of the loan. What happens when interest rates double? Now they may not go up in double over a period of time, but they might. So what happens if that does happen? What happens if interest rates drop? What are you going to do with your money? So the key thing is when you're borrowing money, make sure you can afford it. So how much can you borrow really depends on your cash flow and your incomes. When buying any investments, one of the key benefits of investing is the tax deductions. But what we commonly find is that most people don't actually maximise these. Most people, when they go and buy an investment property, don't actually get a property depreciation report. One, because their accountant most of the time says you don't need it. But the second thing is that most people don't even understand what it is. So the key thing when you're buying an asset is make sure that you are claiming every single tax deduction possible. So what are the property investor statistics? One of the things that we're really concerned about is a small amount of investors that actually go and buy property. Now you'll see by the pie graph that we're showing on your right, that most people that actually buy investment properties don't go and buy a second property and don't go and buy a third, fourth, fifth or 10th property. Now most of our clients that are property investors are buying their third to fifth property within a few years. Now the key thing is that they're not earning high incomes in all cases, but they actually understand how to utilise their debt and make their investments work for them. So the key thing is when you're buying an investment to have a strategy in place. So why would you actually bother investing? Now the key message that we try to put across to all of our clients and to the general community is if you don't, what are you going to live off in retirement? If you don't invest, the reality is you will not have sufficient funds unless you save over 100% of your income every single year for 20 years for you to be able to retire. So if you want to start growing assets, you want to start having the life where you choose how you live, as opposed to relying on the week-to-week paycheck that you get, you need to act on it. If you want further information on anything we've discussed today, please feel free to contact me on 1800 967 548 or email us at info@wealthfarm.com.au.